chip sector is in focus, remains in focus. Last week, we did a bear call spread on SMH for a little contrarian view here, but now we want to do an iron condor. So talk to us about what that is, Harold, and then we will definitely go over to Thinkorswim and look at the option chain.
Yeah, and that trade last week worked out very well. Closed it out in a couple of days for like 30% profit, so it worked very well. So I'm
Nicely done.
looking at SMH again, and we're doing an iron condor. Iron condor, it's a neutral strategy. So what you expect the stock, you don't expect much movement from the stock, either to the upside or to the downside. That's when this particular trade will work out for you. And as we've seen with the market, a lot of your stocks, they're going sideways. So this is an ideal trade for this particular ETF in this case. And I've been trading it. It's been working very well. So it's kind of like a pitcher in baseball. If you got your one pitch that's getting batters out, why go away from it? So I'm sticking with SMH here. So I'm ready when you are to go to the platform here.
Yeah, let's do it. So as Harold shares his screen and then walks through the various data points we need to be taking a look at, we will come back to MarketSmith and then take a look at the break evens. Right. That'll also put things into perspective, but take it away, Harold.
Okay, I'm still disabled here.
My bad. Let me make you co-host. All right, now it should work, Harold. So go for it. And the first thing that we like to talk about, of course, after you type in the ticker, is the expiration for the trade.
All right, so you should be seeing my platform here. And yes, so the first thing I like to do is look at the expiration, how far out I'm going to go. Ideally, I like to go out 45 to 60 days. So, and I like to stick with the monthly expiration. So 39 days out is the closest to that 45 days. So I'm going to go to the August 18th expiration, and I click on that. And then I need to do a whole lot of scrolling down to get to the strikes that I want. So, all right. So on the put side, so we have puts on the right, calls on the left here. So on the put side, I'm going to start out by selling the 142.5 here. So I'm going to sell that, and I'm going to buy the 137.5. All right, so that's the put side of this trade here. Now, to complete the iron condor, I need to go over to the call side here. I'm going to start out, and I'm going to sell the 160 strike here. I'm going to sell the 160 and buy the 165 for protection. And then here is our trade here. So here's our trade setup. We've got a credit 183. Let me lower that a penny so it matches my numbers on the right side. And then I'm going to click on confirm and send. We'll take a look at our numbers. So confirm and send. And of course, our max profit is our credit receipt, and then our break even. So we got a pretty good break even here. These are the numbers you want to keep in mind. You can use the break evens as your stop loss also. So you want the stock to stay in between these numbers here. So let's take a look at our probability of success and how many shares we're going to trade with this stock here. I'm going to click on that. And then on the left side, I've got some numbers here. So our probability of success, how do we calculate that? So first off, we take the width of the spread, which is $5 on both sides. So it's $5 minus the credit received. That gives us a credit. I mean, excuse me, our number here. I forget the term, but anyway, it's $3.18. In option terms, it's $318. We always multiply by 100 to get the actual number there. All right, so that's our actual risk, that $318. Now, to determine what the probability of success is, we take the actual risk, which is that $318, divided by the width of the spread. So that's going to give us a probability of success of 63.6%. So far, so good. Now I'm going to calculate our return on risk. We're putting up money. What kind of return can we expect? Well, determine that. We take the credit received, which is that $1.82, divided by our that 318, and that's going to give us a return on risk of 57.23. Pretty good over a 39-day period. Now, based on the numbers that we've seen, how many contracts are going to buy? Well, we decided that based on our portfolio size, our level of risk, etc., we're going to put $2,500 into this trade. So we take that $2,500 divided by that 318, and that's going to give us 7 contracts. All right, so we're going to change this number to 7, and then look at the numbers here. So again, here's how much we're risking. Again, it's not going to always equal that 2,500, but it's pretty close. There's our max profit and our break even. So I'm going to send this trade off. And then once we're done here, we're going to go back to the chart and look at these numbers at the break even here. So let me send that off, and hopefully we get filled.
Great. Yeah, let's go back to MarketSmith. Nope, that is not what I wanted to do. Let's do this. And we could see a weekly chart of SMH here, and I've marked up those break evens. So on the upside, we've got 160. On the downside, we've got 140. And Harold, that works out because it aligns pretty closely with the high from a couple weeks ago on the upside and the 10-week line or so on the downside. So we do have a little bit of wiggle room here for this trade to work out.
Right. So we like this. Yeah, ideally, you like to see it stay right where it is for the next 39 days.
And go ahead, Justin.
Well, I was just going to say a question for you, Harold. You know, since the iron condor really is a combination of a bear call spread and a bull put spread, if you do knock out one of those break evens, and again, you've got those clear lines in the sand. If you go above or below one of those lines, do you take off the whole position, or do you take off one of those legs of it?
Yeah, good question. I take off the whole position. So I don't bother with trying to say, okay, well, this side of the trade is working, I'm going to get it out of the trade. So, you know, if the bear call spread is working, then I'll close out the put spread. I don't do that. I go in with one trade then I'll take the whole thing off. So I don't bother with dealing with the legs there.
And one other question I had is, okay, the calculations that you give each time here, you know, the probability of success and the return on risk. I mean, there's obviously a relationship there, right? The probability of success as that goes up, you know, the
return on risk is probably gonna go down.
The return on risk goes down, right?
Right.
Right. Because you can't get something for nothing. So is there a level that you look at of, oh, I want my probability to be success at this level, or on the flip side, I want to have a return of, you know, X amount before I even bother with the trade? Because you can have a high probability of success, but you're like, well, gosh, this isn't giving me much.
Yeah.
Right.
And in that small 10% of the cases where maybe it doesn't work, or 5%, whatever, you could lose a lot more, you know, and so maybe it's not worth it in that regard. Are there any guidelines that you use to say, this is worth it, or this is something I should pass on based on those?
Right. When that probability of success gets too high, and I say too high, around 75% or more, that's when I say, okay, this is too good to be true. All right. And so I like it when it's in the mid 60s, 70, in that area. So that's my comfort zone. You get to the mid 60s, 70% on that probability of success. That's where I like to see that. And that's when I'm comfortable with the rest of the trade.
Great. And then in terms of how the trade plays out, because the SMH trade from last week, you know, you closed that out within a couple of days. So what would be the exit strategy here?
Yeah. So I close it out to one of my personal rules is if I get a 30% profit in the first 3 days, I close out the entire trade and take the money and move on. That's what happened with the SMH a week ago. It moved very quickly and it was very profitable quickly. In this case here, your iron condors tend not to do so, not because you want that sideways movement. So I'll be setting my exit strategy at 50% of the credit receipt. So you just take that credit receipt, which was $1.82, divide it by 2. That's going to be your, that's when I'm going to be closing out this trade.